Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. It is Monday, so today's episode will be very finance and economics heavy. We begin with general economic updates. While the economic situation remains painfully shaky in China, with acute structural crises facing leadership, we may finally be seeing some signs of stabilization, which would provide policymakers with some desperately needed breathing room. Let's start with manufacturing and services data, both official and unofficial. According to official numbers published by the National Bureau of Statistics over the weekend, the Purchasing Managers' Index, PMI, rose to 50.2 in September, from 49.7, representing the first time in 6 months that China's factory activity has expanded. Then on Sunday, yesterday, Chinese financial media outlet Caixin published its Caixin China General Manufacturing Purchasing Managers Index, which gives a more independent snapshot of the sector, which slid to 50.6 in September from 51 the previous month. The PMI is one of the earliest available monthly indicators of business activity in China. In the first half of this year, manufacturing accounted for more than a quarter of China's GDP, according to government data. Quote, various important economic indicators have shown marginal improvement, and the macroeconomy has shown signs of stabilization. However, the economic recovery has yet to find a solid footing, with insufficient domestic demand, external uncertainties, and pressure on the job market. End quote. The PMI sub-indexes were a mixed bag. Employment in manufacturing fell into contraction in September, only expanding twice this year. Companies increased purchasing activity for the second straight month due to greater demand. Stocks of finished goods grew for the third consecutive month, but at a milder pace. On balance, analysts are hoping for stabilization when looking at all this data. Zhou Hao, chief economist at Contagion International, for example, expressed today, quote, the manufacturing PMI plus the good industrial profit figures suggest that the economy is gradually bottoming out, end quote. The Caixin China Services PMI was also published over the weekend. According to these numbers, China's services sector in September grew at the slowest pace in 9 months. Quote, with sluggish job market expansion and subdued business confidence serving as drags, end quote. The index, which covers the operating conditions in industries such as retail and tourism, dropped to 50.2 from 51.8 in August. Chinese financial media outlet Caixin writes that the slower expansion in both manufacturing and services activity indicated that growth momentum weakened last month despite the government's persistent efforts to spur the economy. Adding, quote, policymakers rolled out a fury of supportive measures over the past few months, including those to encourage consumer spending, rescue the slumping property market, and bolster the private economy. End quote. Meanwhile, China's so-called Golden Week holiday period kicked off over the weekend on Friday with the Mid-Autumn Festival, which will be followed straight after by the National Day break, which ends on the 6th of October. During this time, economists will be following near-term data, especially consumer spending, quite closely. According to state media, passenger travel by rail on Friday, the first day of the Golden Week break, reached 20 million trips, a single-day record, with the article expressing hopes that the country will see, quote, the most popular Golden Week in history, end quote. There are several other early indicators we need to discuss too. According to SpaceKnow, a US company that analyzes satellite images, activity around Chinese shopping malls remained at relatively high levels in September following an increase in August. In addition to this, traffic congestion in China surged in the week to September 27th. Morning Consult's Index of China Consumer Sentiment was good in September, though slightly weaker versus August. World Economics All-Sector Sales Growth Index for China increased to 53.1 in September, a 6-month high. All these indicators would suggest that China may finally be seeing stabilization in the economy, though that doesn't mean by any stretch of the imagination that China's economy is out of the woods, of course, or seeing strong recovery. But it does give policymakers a bit of room to maneuver after months of poor performance. Indeed, late last week, the International Monetary Fund expressed that it sees some signs of stabilization in China's economy and stressed the need to use this opportunity to push for much-needed reforms in its economy and rebalance from investment towards consumer spending. Chief IMF spokesperson Julie Kozak said that after a major slowdown since the first quarter of 2023, quote, very recent data has been a bit more mixed with some signs of stabilization, end quote. Adding, quote, we expect that China's growth will slow to around 3.5% against the backdrop of demographic headwinds and slowing productivity growth, but we also think that higher growth over the medium term is within reach for China. China should seize the opportunity to rebalance its economy through short-term macroeconomic policy support and medium-term reforms. End quote. Okay, that is some of the more positive news. Up next, we discuss the more concerning question of whether the property crisis will trigger a financial one. Hey everyone, if you enjoyed today's episode of China Update, don't forget to hit the like button. Liking, sharing and subscribing is one of the best ways to help the channel grow and be shown to new people. And for anyone who can go the extra mile and help me keep the channel financially sustainable and primarily subscriber supported, Patreon and Buy Me a Coffee links are in the description below. It's just me making these episodes, but with your support, I know I'll be able to continue. Thank you so much everybody for the ongoing support. According to preliminary data from China Real Estate Information Corp published on Saturday, the value of new home sales among the 100 biggest real estate companies fell 29.2% from a year earlier to 404 billion yuan, $55.4 billion, narrowing from a 33.9% decline in August. Sales were up 17.9% month-on-month. This represented a moderated decline in September despite greater efforts from Beijing to support the housing sector. China Index Holdings data also found that sales in September were down versus August. We remember that new home prices fell the fastest in 10 months in August, and property investment declined for an 18th straight month. Sunday data, that is data released yesterday, shows that China's new home prices rose slightly in September, rising 0.01%, breaking a 4-month decline. Home prices are very politically sensitive, however, so we need to take this tiny increase with a grain of salt. Over the weekend, US-based Wall Street Journal published an excellent piece titled, Does China's Property Bust Make a Financial Crisis Inevitable? Arguing, quote, perhaps not if Beijing plays its cards right, but serious damage to the nation's prospects is still likely. End quote. For the rest of the video, we will be looking at this particular question. On this question, the authors of the Wall Street Journal article make 4 points. 1. Indirect exposure. Banks' seemingly manageable direct exposure to property is deceptive because of the housing market's deep links to 2 other key borrowers, heavy industry and local governments. The good news is, argues the outlet, that, with the exception of steel itself, the heavy industries at the heart of China's last big debt and housing crisis, that is, the crisis of 2015, metals, coal, cement and chemicals, are in better shape this time round than they were the last time round. 2. Going local. The bad news, the piece continues, is that another heavily indebted sector that ran into trouble in 2015, local governments, as regular viewers know all too well, quote, may actually be much worse off this time, end quote. 3. Rolling over. The real problem for banks, says the Wall Street Journal, therefore, probably isn't mortgage exposure. Rather, it is that the continuing property buyers' strike among households is starving developers and local governments, 2 of the economy's biggest debtors. Moreover, local government-owned corporate financing vehicles have also issued substantial bond debt. This is also an area that we've covered in depth in previous videos. China's biggest banks are still in good shape, says the Wall Street Journal, but the picture looks less rosy at smaller and particularly rural banks. Gavical Dragonomics believes that a 1.5 percentage point rise in non-performing loans would push rural banks' capital adequacy ratios below the regulatory minimum of 10%. Back in 2015, non-performing loan ratios rose by 1%. 4. Relief measures. Authorities are well aware of the risk to rural banks, says the Wall Street Journal, and local government finances. They have been aggressively recapitalizing small banks since 2020 because of this. The piece concludes by observing, quote, China may well avoid a systemic financial crack-up in 2023 and early 2024, but it is unlikely to avoid serious damage to banks' balance sheets, even at healthier lenders. That will have its own costs, less cash available to support small businesses and grandiose industrial policy, and ultimately, probably slower growth. End quote. We end today's video with observations made today by Peking University's Michael Pettis on this very question of financial distress impact of the real estate crisis in China and whether it can spread through the financial system. Quote, while we are unlikely to see a financial collapse or anything so spectacular, we are instead likely to see a creeping ossification of the banking system as the gap between revenues from assets and the cost of servicing liabilities widens. This gap can only be resolved by default, which is very unlikely, or by explicit or hidden transfers, including in the form of repressed deposit rates. While authorities have been recapitalizing small banks since 2020, we must distinguish between recapitalization at the individual bank level and at the systemic level. When local governments borrow from other banks to increase the capital of a specific bank, that bank's capital is increased, but the capital of the overall banking system isn't. If there is a problem with an individual bank, in other words, the additional capital will help that bank survive. If there is a systemic problem, however, the additional capital will be useless. That's because problems in one bank will automatically spread to other banks directly or indirectly through its debt to those other banks. You can only capitalize a banking system with capital from outside the system, never from capital within the system. Unfortunately, in China, with its closed and highly integrated financial system and the tight relationship between banks, state-owned enterprises, and local governments, it is hard to see where outside capital can come from. End quote. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a wonderful Monday, have a productive week ahead, and I will see you all tomorrow.